All right, March is here. We are in the middle of fake spring, waiting for another round of rainy weather before we get into real spring in the Sacramento region. Economic reports are all over the board. Bitcoin has basically given back all the gains that it made in the last 4 months. The Fed has come out and in their recent comments said that they are going to hold their short-term interest rate stable for the foreseeable future as they pay attention to any economic trends and try to get a handle on the data that's coming in now before they make any further decisions. So good news in all that, mortgage rates have come down a little bit. So before you get too excited, they are still hovering in the high sixes, obviously, depending on your individual profile and credit. But hey, you know what? Any decline is great for buyer affordability. So really nice to see that. Hopefully that trend will continue throughout the year. And again, I'm highly doubtful that we will see mortgage rates in the 5%, but even if we get down to mid or even low sixes, that would be amazing. So we'll just have to wait and see. All that is dependent on other aspects of the economy, the stock market, and the bond market. So we'll see how it goes. The auto loan industry. Auto loans and credit cards are having a rough time right now. Auto loan delinquencies are the highest they've been since, actually in the last couple decades. I don't have an exact date, but credit card delinquencies and defaults are up to the highest level that they have been since 2010. So not great. I think a lot of us were waiting to see how much of that increased credit card usage and balance was due to obviously holiday spending. And then oftentimes a lot of that will get paid off over the first couple months of the new year. We're not seeing as much of that. And those delinquency rates are increasing. So definitely something to be aware of, pay attention to. So what does all this mean for the housing market? There are pros and cons. General economic outlook is that some softening could put downward pressure on certain asset classes. That could be some good news for those trying to get into the housing market. The challenge with that is if sometimes the asset prices are coming down, that means there are larger systemic or economic issues with the economy as a whole. And while some buyers might enjoy the lower pricing, they might not have the financials to be able to make the purchase at that time. So there's a lot of things that are all very much integrated. Anyway, my opinion overall is that the housing market saw such a massive crash back in 2008. Just completely got wiped out. And it was built back on pun intended, such a strong foundation over the next basically 10 years now. I'd say 15, depending on where the exact bottom of the market was, that the housing market is so stable right now that I would say it's probably the one area of the economy that may not be as impacted by everything else. So just to give you an idea, about 40% of homes are owned free and clear across the country. And for the remaining 60% that actually have mortgages, about 55%, so over half of those have mortgage rates under 4%. That basically creates an incredibly strong base for the housing market. And just one more reason that even when rates went up, we didn't see housing prices drop in the Sacramento area, because a lot of those owners said, hey, I don't have to sell. If I don't get the price I want, I've got a great rate, a great payment. I'll just ride it out and I'll stay here. So that trend will continue as far as I can see. Good news is that does equal stability, which is nice. I will say some other states, some other regional markets are having a really tough time. They're actually seeing home values decline. I don't expect that in the Sacramento region. I think we're going to be a little bit insulated from that. Some other states are seeing statewide home value increases. Some are seeing decreases. And then obviously within that, you have the submarkets, the major metro areas. So overall, I think we're going to be pretty stable. And the other thing, I do have the opinion that so many folks have a really great mortgage payment. And basically, if they tried to rebuy their exact home at today's rates, to keep the same payment, they would get a much, much smaller home, or their payment would jump significantly. So when it comes down to, trying to keep that $3,000 a month mortgage payment, it's that, or maybe letting go of the brand new luxury vehicle, or, restructuring everything else so that you don't lose that great housing payment. So I think overall, people are going to fight to keep the house and restructure everything else, which again leads to stability in the housing market. So I would say overall, my biggest concern for our local market here would mostly be massive job loss. If the unemployment rate just skyrocketed across the Sacramento region, that could be one factor leading to things declining. Again, probably not as much because we do have a really strong market here, but that could result in some declines instead of the slow, stable growth that we've been seeing the last few years. So the only other, we'll call it an honorable mention, could be if enough folks get called back to the Bay Area, the return to office orders. If enough of those people have to put their homes on the market or decide to put their homes on the market instead of renting them, which many may do, we could see a temporary increase in an inventory and obviously basic supply and demand economics. If that supply goes up, the demand could go down. We might see home prices soften up a little bit. Again, I'm going to say that's an honorable mention. I don't think that's a very likely scenario. And some of those folks may just say, fine, then I'll find a different job. It might not pay me my Bay Area salary, but at least I don't have to move. I love the quality of life here. We're going to find a way to stay. So let's dig into it. Tri-County area. Homes for sale increased 13.9% for the month. Pendants are up 11.8%. And the sales have finally started to come around. Those increased 2.6% for the month of February. So good news overall to see some positive improvements in those numbers across the board. Days on market dropped from 51 to 47 days. List price to sale price ratio increased 2%. So it jumped up from 96 to 98%. That's great news for spring. The median sales price in the Tri-County area increased 2.6%. So it went from $575,000 up to $590,000. And that is actually 3.1% higher than February of 2024. So year over year, we're looking good. Months of inventory increased by 8.8%. This is great for buyers. If you're a buyer and you've been having a little bit of a challenge finding inventory or finding homes that you like, increased inventory, that's good news for you. There may be some more options coming along. So moving closer to home, Placer County. Homes for sale jumped 13.8%. Pendants are up 11.5%. And sold homes up 18.4% in Placer County. That's a huge jump. Great start to the spring season. That's a nice increase, although we did see some really flat sales activity. So, while it sounds great, we might just be getting back to a little bit more of a normal trend. Days on market dropped from 60 to 50 days. That means the market's moving a lot faster. That's great news. And that's actually 16.7% improvement. So that's a solid percentage. The list price to sales price ratio, wow, jumped 4.3% in Placer County. So homes are now selling for 98% of list price. My take on that's a pretty big jump. I suspect that part of that is due to the increased sales activity, motivated buyers jumping into the market. But I do think a small portion of that is sellers actually being more realistic about their initial list price when they come on the market. So instead of trying to get these outrageous prices, they are being more realistic for what the market will actually bear in today's market. So I believe it's a combination of the two. We'll see how that looks over the next couple months as our spring starts to trend. Months of inventory in Placer County dropped 2.7 to 2.6%, which is interesting for the time of year. That means there is some really strong demand. And even with the increased availability, the increased number of homes for sale, the month's worth of inventory, basically the absorption rate actually dropped. So we're seeing really strong demand. Overall, I would say our Sacramento real estate market It's not going to be a crazy great year, in my opinion. We're not going to see some 10% price appreciation. We'll definitely see some strong numbers here in the springtime, and then probably a little bit of a taper off the second half, or maybe once we get into the third of the year. So heading into late fall and into those winter months, we may see a little bit of a drop off. But overall, year over year, trending in the right direction. Thankfully, not crazy, but hey, just consistently solid. I'm okay with that. So obviously all the wild cards right now, everything happening in the broader economy, a lot of changes with this administration. So I'll do my best to kind of interpret those, whether it's a positive or negative, how that can impact you, impact the housing market, and just bring you the data so you can make your own decisions. So please follow the channel. Like the video. If I can help you with anything specifically, please reach out directly. I'd be glad to make an appointment, sit down with you, and go over your individual needs, either to buy or sell a home in the greater Sacramento region. And thank you again. I'll see you next month.